Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Welcome to Joe Knows Retirement. Today we are going to be talking about how to lower your required minimum distributions. Yeah, those things that the government forces you to take out eventually when you reach a certain age. And typically what we see is most people don't want to do that. So we're going to talk about ways to lower that burden so that you can pay less taxes over your retirement. And so if that's intriguing to you, then you're going to enjoy this episode today, and we're going to get right into it. So how I want to break down this episode today is I'm going to talk about four things. I'm going to talk about what is an RMD. I'm going to talk about who an RMD is going to be an issue for. And I'm going to talk about why an RMD is an issue. And then lastly, I'm going to talk about how do we solve this? How do we lower these RMDs? And so we first look at what is an RMD. It's when you turn 73 or 75, the government forces you to take out that money. Now, you're probably thinking, wait, I didn't know that was the case. I thought it was 70 and a half. Well, it was, and then they changed it to 72, and now it's 73, and then it's actually changing to 75 if you were born in 1960 or after. So you want to make sure you're aware of what is your age and what is that RMD going to be for you. And so that's what an RMD is. Now, why does an RMD exist? It's because they want their money. They want you to pay your taxes on the money that you've saved all these years and you have not paid taxes on it. So these RMDs apply to those 401ks, those IRAs, those 403bs, that TSP, that Ohio deferred comp, deferred comp if you're in a different state. These are the tax deferred dollars, all that employer saved retirement accounts that when you put that money in up front, you got a tax deduction. And so what happens is as this money's grown and grown and grown, you have not yet paid taxes. And so you have this big bag of money right here that the government can come tap into and get some revenue, get some tax revenue from that when it's time for you to take it out. But if you never take it out, they're going to have to keep waiting and waiting. So they put the RMD in place as a way to get that money from you while you're living. And so that's the required minimum distributions that we're going to be talking about today. But also take a side note that when you pass away, and let's say you leave this money to your kids, they're going to have to take it over 10 years. And their RMD is over 10 years, which again, why is the government doing that? So they can get more of that revenue over the next few decades because they see that the baby boomer generation, 10,000 baby boomers turn 65 every day. That's going to happen for 10 more years. It's already happened for the last 10. They see an influx in the system that, okay, all of these people are going to be reaching required minimum distribution age, so they're going to be taking that out. And then a lot of them are going to be reaching life expectancy, which means they're going to have to take out more as well. And so I see that the government sees this as a big opportunity over the next few decades to really get some of this tax-paying dollars out of our pockets and get some of that revenue that they're so in need of, considering they're $34 trillion in debt. So if you listen to anything I've done before, you've always heard my perspective. I mean, I think tax rates have to go up. I mean, right now we've got more interest on our debt than we have revenue coming in. Yeah, I said that if you're wondering if that's true or not. More interest coming in than we have revenue paying out. So what that means is that we're basically operating as a deficit just from that. And so knowing that they see a big opportunity to grab some money, my question to you is, what do you think tax rates will be in the next 10 to 20 years, knowing that people are going to be having RMDs or they're going to be passing away and now the kids are going to have to take it out in 10 years. So believe what you want, but I would rather be prepared for whatever may happen so that I can pay the least amount of taxes is ultimately our goal. And that's how we plan for our clients moving forward. So that is what an RMD is. Who is an RMD most severe to? It's most severe to those who have much more in the tax-deferred investment. So here's how I typically explain it. If you have $250,000 or less in a tax-deferred vehicle, the 401k, the IRA that I just mentioned, your RMD is probably not going to play a big problem for you unless you have a big pension. But if that's all you have in Social Security, you're probably going to be able to take out of your RMD and stay under the standard deduction, which, for this year, for 2023, it's $27,700. For 2024, it's just a little more than that. And so knowing that that's the case, you're probably not going to have to worry about your RMDs causing any trouble. It starts to become a trouble when you have 250,000 to 1 million. And that's when you have to start being careful. And the reason why is because now your RMD is starting to grow. The higher your investment is, the more you have to take out. So the way an RMD works is that if you have $1 million in your 401k, for example, you're going to be required to take out about 4% of that when you reach age 73. And then when you're required to do that, that's going to be about $40,000. Well, the problem becomes is as this $1 million continues to grow and grow and grow throughout retirement, so does your distribution rate and the amount that you have to pull out. And so by the time you're age 90, you're going to have to take out about 8 or 9% from that 401k for that RMD. And so is that going to lead to huge tax problems in the future is ultimately the question. Because not only is your investment growing, but also the amount you have to take out, which means the RMD is going to continue to skyrocket and force you to take out more money. And so we actually refer to this as a retirement tax time bomb. You may have heard that term before, because if we don't get onto this now, if we don't plan for this now, it's only going to lead to big problems moving forward. So we really want to be intentional here, and we got to be proactive, not reactive. Got to get ahead of things, right? And so that's the deal. And so if you have 250 to a million, you got to start paying attention to this. Is it going to be as severe for you versus someone who has $1 million plus? Well, probably not as severe, but I would still consider that 250 to $1 million. They got to get moving. Now, if you have $1 million or plus, you're not really you don't really have any options. You've got to get moving now is typically what we're seeing, because again, your RMD is going to start out at $40,000 and never be lower is typically what we see. And if you have $2 million, that's your RMD is going to be $80,000. If you have $5 million, right, as you can see, the more you have, the more of an issue this is. I mean, if we deal with clients, we always say we make the most impact with our clients who have $1 to $10 million saved in their tax deferred vehicles, because you're not going to see a ton of if you just do nothing, you're not going to see any opportunities just present themselves. You got to get actually moving now to start to lower that amount in tax deferred and start to have more of a balance. So we're going to talk about something called a Roth conversion later in the episode. But with a Roth conversion, you take money from the tax deferred and move it to tax free. The problem is that most people have all their money in tax deferred right now, and not many people have it in tax free. Well, there's a solution. We just have to start to adjust that by moving and having more of a balance, so we can have the flexibility and control to take out of which investments we want from a tax perspective. So that's something we'll talk about throughout today. But again, just want to emphasize that if you have $1 million or more saved, make sure you're worried about RMD planning and making sure you're trying to lower those RMD is typically what we say. And the reason why, and this is going to go into the next point of, we talked about what is an RMD. We talked about who it's most severe to. That's what we just discussed. Now let's talk about why is it so severe. And the reason why, let's just use that $1 million as an example, is if you have to take out $40,000 and you're taking out Social Security, you're probably going to force your Social Security to now become taxable, and it could be fully taxable depending on your situation. Well, if you don't know this or not, Social Security used to be tax-free, but now most people have to pay taxes on the Social Security check that they receive it in that type of instance. Now, the good news is that you can keep your income low enough and still get your Social Security tax-free. So I often joke with people, hey, would you like to learn how to get your Social Security tax-free? Of course, right? And so the way you do that is by lowering your RMDs, by lowering your income, by showing the government that you have a lower income in retirement. And so Social Security is calculated on something called the provisional income. And with the provisional income, that's going to be, dependent on half your Social Security, your IRA distributions, any earned income, pension income, capital gains, non-taxable interest. There's a lot of things that add into this. And so you take that number, you go to the provisional income chart, and that's going to show you how much of your Social Security is going to be taxable. And so if you have a big RMD in that calculation, that's probably going to force your Social Security to be nearly fully taxable. And again, it doesn't have to be if we plan the right way. So let me just share an example. So we've got a client, they've got $1 million, and they pay no Social Security tax each year. And the reason why is because we take out from their Social Security to cover their $100,000 income need. We take out from a Roth IRA, which does not count as tax, does not count towards that provisional income. It's tax-free. And then we take out just enough from the IRA to fill up the standard deduction and to stay in the lowest provisional income with Social Security to keep that tax-free. Well, they're still living on $100,000. We were just able to structure their plan in a different way to make sure they got that $100,000 in a very clean way, in a very tax smart way, so that we didn't have to pay more in tax than we need to. Because even if you're in the 12% bracket or the 22% bracket right now, if you force Social Security to be taxable, each dollar you pull out, beyond a certain point, you may be paying an all-in tax of 25 or 28%, or you could even pay a 40 or 50% due to the Social Security tax torpedo. And so, that you got to factor in all taxes, not just federal income, not just what you're paying, on the federal tax brackets, but you also have to look at what are you going to do to Social Security? You're going to force that to become taxable? And if so, maybe we don't want that to happen. We want to stay lower. Well, in order to have that type of control and flexibility, we need to find ways to lower RMD now before that time happens. And so that's the type of planning we do with a lot of our clients. So again, we'll talk about some solutions here soon, but one idea is you could look to delay Social Security, start to do some of these Roth conversions, or start to take out money from your IRAs or 401ks now before you reach RMD age. And that's going to allow you to lower your RMD, but also take advantage of lower tax rates today. And then another thing that we need to understand about the severity of an RMD is higher Medicare premiums. This is one that I think it upsets people, and rightfully so. I mean, think about it. You've done a great job saving for your retirement, and because of that, you're going to be penalized because you've been a great saver. The person next door who never saved a penny, never went to work, just hung out at home, they may be paying the least amount possible for Medicare, but you could be paying a higher amount all because you've saved. I don't know about you, but I don't think that's fair considering that they're both going to get the same amount of coverage. So why pay more for coverage that shouldn't cost you as much as the idea? And so when you think about Medicare, the way it works is Part A is no cost. That's what you paid into all your life. Part B is going to have an added premium. And again, it's means-based, which means it's based on your income. So the higher income, the more you have to pay, as I'm explaining here. And what we see with people who are really high income earners in retirement through their RMDs and Social Security and other incomes, they're going to have very little left in their Social Security after they pay for Medicare for each of the spouses, or if you're single, whatever the case may be. And so we don't want that to happen. We want you to actually see that Social Security check that you've worked hard for. We want to see it and make sure that not as many taxes are pulled out of that. We also want to make sure that Medicare is not going to be pulled out of that as much either, because as you know, Medicare comes out of your Social Security. They make the payment out of that Social Security check. So if you want to maximize that, we need to make sure we don't pay more in Medicare premiums than we need to. And also understand Medicare premiums are a tier. So as soon as you reach it, you've got to pay it. So we got to be very careful when doing tax planning to make sure that we are staying under that, or maybe we look to blitz it for 1 year. We look to really pay a high Medicare premium for 1 year, and then that's going to allow us to pay lower Medicare premiums for the rest of our life. So that may be some planning things that you look at, is maybe we blitz it and try to pay more in Medicare premiums, for the next 3 years, and then not have to worry about it. Also understand with Medicare premiums that it goes back 2 years. So if you're 63 today and your income is really high, you're going to pay for that when you're 65. Okay, so they're going to look back at your income 2 years to decide what your 65 Medicare premium will be. Again, it's means-based, it's based on your income, and they'll go back 2 years. And then at 66, they'll go back to 64, and so on. So those are things to look out for. The next one reason why lowering your RMDs, can be a good thing is because of the capital gains rates. So currently today, the way capital gains rates works is that most people pay about 15%. Now, if you're a really high income earner, you have to pay 20%. And then if you are a low income earner, you pay 0% on your capital gains. Many people don't know this, so hopefully this can help someone. So if your taxable income is low enough, then you don't have to pay any capital gains. And the number's pretty high. For 2024, I believe it's in the 90,000 or so. And so if that's the case, 90,000 plus your standard deduction, which is close to 30,000, you're going to be able to take out $120,000 and get it at 0% capital gains. Right? If you had no other income, and if you had income, it adds into that. But you get the idea. And so if you have a really high RMD and you have a really high Social Security, well, now you may not have as much room or none to utilize that 0% capital gains bracket. And so if you have any investments that are subject to capital gains, you may not have the necessary opportunity to harvest those and to sell them off at 0%, and continue doing that each year in retirement. Versus if we have a lower RMD, now we're going to have more room and time to utilize that 0% bracket so that we don't have to pay any capital gains tax on some of those investments. And the alternative is if we do have that large RMD, we do have that large Social Security, well, now we're always going to have to pay 15% if we ever want to take out money from that investment. So that's another opportunity that lower RMDs can allow you to do. And then the other severity of just the RMDs in general is what future tax rate's going to be. So I've already talked about this, but I mean, if you think tax rates are going to be higher, then why are we not doing anything about this? Right now we're under the Tax Cuts and Jobs Act until 2026. So what are you doing today to prepare for that? And especially knowing that we've had since 2017 to start taking action. And so I always tell people, like, if you have not been doing anything since 2017 from a tax planning standpoint, you better get to work, right? We don't have as much time left. Tax rates, in my opinion, have to go up. And so if that's the case, what are we doing? Are we just sitting here thinking tax rates aren't going to go up? If that's the case and that's what you believe, then more power to you. But most people I ask that question to, they always say tax rates are going up. And so if we haven't been doing anything the last few years, hey, I'm not here to beat you up, but we got to get moving. And so 2026 is when tax rates go up, back up to where they were in 2017. We're seeing an environment right now where tax rates are among the lowest that we've seen in history. So now's the time to get moving on this, especially not knowing what tax rates will be in the future. And so if we can start paying tax on our investments today, it's either pay it now or pay it later. And then you have to decide, is it going to be at higher rates or lower rates? Also, you got to keep in mind with everything I just mentioned. If you wait, you may not be on Social Security now. But if you wait, now you're going to be on Social Security, and now you're going to force that to be taxable. Or if you wait, maybe now you're going to be worrying about Medicare premiums where you may not worry about them right now if you were to do Roth conversions or take out extra money or whatever it may be. So those are just the ideas there. All right, so let's talk about lastly here of how are we going to lower these RMDs. So there's many strategies, but I want to make it really simple. I've already mentioned this one before, is Roth conversions. So Roth conversions is where you take it from the tax-deferred investment to the tax-free. This is one of the more popular strategies we're trying to do with people before they reach RMD age to start preparing and lowering it to the point when they get there. So I've already talked about some of the reasons why we would do this. Lower tax rates now, we're expecting them to be higher. Do it now while, so that all the growth in that investment can be tax-free, right? If you don't do this, then your investment's going to keep growing, and so is your RMD, and now you're going to be forced to take out higher amounts at unknown tax rates. And so those are some of the reasons that you would start to do Roth conversion now. Another opportunity that you could look to start doing is just taking out money. Just taking out money for income, right? So we talked about this strategy a little earlier. Hey, maybe we delay Social Security and we'll just live off our investments now. We won't have to worry about Social Security tax. We won't have to worry about, getting a lower Social Security benefit, because the longer we wait to take Social Security, the more we get. So that could give us more guaranteed income for the rest of our life. And so that could be an opportunity there, is maybe we just live off our investments. Or maybe we just take out some investments. Maybe we have some high interest debt we can pay off. Maybe we want to do some gifting and we can start to do that. Maybe, whatever it may be, there's just a lot of opportunities we can start to just take that out and either do a Roth conversion or just take it out and go on a big trip or whatever you may want to do with that money there. Another opportunity that we're looking at with people to lower their RMDs, and this one's more so when someone is at RMD age, or they can actually start doing this at 70 and a half. And this strategy is called a qualified charitable distribution. We call this a QCD, qualified charitable distribution. And so what you can do with this is you can give money directly from your tax-deferred investments, that IRA, that 401k. Well, typically you can't do it in a 401k. You have to roll that 401k over to an IRA, which is very easy to do. But once it's in an IRA, you can send that money to a charity called a qualified charitable distribution, and it's all tax-free. So normally when you take that money out, you got to pay taxes, but if you just send it right to the charity, you're good to go. So we had a guy, he was giving $10,000 to his charity every year, just straight from his pocket. And I said, Tom, what are you doing? I'm like, just if you just give this $10,000 from your IRA to the charity, you'll save $2,500 in taxes by doing that. 22% federal and about 3% state that he was able to save just by sending that over. And he's going to be able to save that every year for the rest of his life. He's going to be able to save $2,500. And so the way he looked at it is, well, now my charity gets more money because I don't need the money anymore. I've done a great job. I'll just give them, instead of $10,000, I'll give them $12,500 each year because of the tax savings. So what an impact that could make. He increased his charitable giving by 25%. Just by being tax smart, just by understanding the rules and knowing how to enact them. So if you're a 70 and a half or older and you are charitable minded, making sure you have this strategy in place is going to be extremely important. And then understand, once you reach RMD age, 73 or 75, you can actually, if your RMD is $20,000 and you want to give $5,000, you give $5,000. Now you're only required to take out $15,000. So it can lower that RMD there for you. So again, if you're 70 and a half, start doing that. If you maybe, here's a neat strategy. So if you're 69 or 70, we've seen people that, and I'm not necessarily advocating for this, I've just seen people do it. They won't give anything in those years. and then they'll give double when they reach 70.5 just to get the added tax benefits. So it's called bunching your charitable deductions. We see a lot of different people do that. So that could be an idea for you as well. And then also just be prepared if you're 70.5 or younger. Just be ready for that time to come, and that may be a reason why you don't want to Roth convert everything, right? People say, well, I'll just Roth convert everything. I don't know if that's always the best idea. Most of our clients do not Roth convert everything because we want to utilize lower brackets in retirement. And we also want to make sure if they're charitable, we've got enough money to give tax-free out of those tax-deferred vehicles there. So those are some of the main strategies that we're looking at to lower your RMDs. Again, this is something you got to be proactive and start getting moving on now, and just make sure that you are not paying Uncle Sam more than you need to. So obviously, as you know, I wrote a book on this. We've got a whole chapter on required minimum distributions. The book's called I Hate Taxes: Lower Your Taxes and Own Your Retirement. And we talk about, hey, if you don't control these RMDs, you're going to have to pay way more in taxes. You're not going to control your retirement. So give that book a read if you haven't already, and enjoy the rest of your day. And I hope you enjoyed this episode of Joe Knows Retirement. We'll see you on the next one.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.